So now we're going to talk about the presentation and disclosure aspect of Ind AS 19. We've covered a whole lot of ground in relation to the accounting, the recognition, the measurement of all different types of thing, whether it's a short-term employee benefit, whether it's a post-employment benefit, whether it's other long-term employee benefit plan in a way, or it is in relation to the termination or settlement. Unique thing was termination, remember, right? That you have to record it earlier, right? Earlier of as and when there is a common understanding between the employer and the employee. And so all of that is what we discuss. We discuss at length what is defined contribution, what is defined benefit, what are the different components of defined benefit. You apply a statistical model, you engage with actuary. There are a lot of assumptions which goes into it. Then there are a lot of tables, right, of the current which is current benefit obligation, then plan assets, then actuarial gain or losses, and then your remaining obligations, or your, if there is a surplus, then there are rules around asset ceiling. In a way, whole host of thing, is what we discuss. And then there are different types of plans in different countries if you're operating in a multi-country environment. So the disclosure requirements are again very, very comprehensive. And as I said that this is one footnote which we see is one of the biggest footnote in the financial statement. So we need to be careful here, I think. But from an examination perspective, I don't expect that a lot of this will come through. But you need to be aware about, how do some of these disclosures look like. So there is a possibility of offsetting, which I said that if I have a funded plan, you got to look at the offsetting in a way that the assets, the creditors in a bankruptcy situation do not have access to the assets of that fund, right? So we talked about that, right? Funded plan and unfunded plan and all of that stuff. So legally enforceable right to use a surplus in one plan to settle obligation under the other plan. So you got to again be very, very careful. So you got to look at the offsetting principles. You got to look at the current and non-current distinction, whether entity should distinguish current and non-current portion of assets and liabilities. So most of this we see classified as non-current in nature. The components of defined benefit cost, you got to present those components in accordance with the Ind AS 1. So a host of other disclosures you need to be careful about. So type of plans, right? The nature of benefit, description of regulatory framework, any other responsibility for the governance of the plan. So as a reader of the financial statement, I know exactly what is the obligation or type of the plan the company is providing for its employees. The risk, if you are there, are there actuarial risk or investment risk? Are they sitting on the company or they are sitting on the employee? All of that. Plan modifications, if there are plan modifications, I need to disclose that as well, whether by their plan amendments, curtailments, settlements. And again, always remember, disclosures is always in the context of materiality, right? If things are not material, then of course we don't need to disclose. If this is material, then only we need to disclose from that perspective. And always remember, under Ind AS, disclose, 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 right? That's the key. And then reconciliation from opening balance. So when you look at a defined benefit obligation, or the opening balance, closing balance, the way we saw in one of the tables. Similarly, on plan assets, opening plan asset, closing plan assets, how much you contributed, how much is the withdrawal, how much is the actuarial gain or loss. All of that is what we need to do. I need to also disclose the fair value of transferable financial instrument if you have. So bunch of disclosures, right? And then there's a host of reconciliations which are listed in para 140 in question of the current service cost, the interest income, the remeasurement, past service cost, the change in foreign exchange rates, the contribution to the plan separately for employer and by plan participants. So all of that is what if there any effect of business combinations, we need to disclose. So whole host of disclosures um, uh, about timing and uncertainty of future cash flows, right? When you see that, it also requires, defined benefit plan, that what are likelihood of payment, over a future periods. You need to do also a sensitivity analysis if I were to change those assumptions and those actuarial assumptions, right? The demographic assumptions and the financial assumptions, some sensitivity analysis, depending upon, again, the impact of that is material. Description of any asset liability matching strategy, I need to disclose that as well. And impact of that on the future cash flows, expected contribution for the next reporting period, and maturity profile. How do I, or what period I'm going to pay. So bunch of disclosures. I would encourage again each of you to kind of go through the slides, read them at your leisure, and just make sure that you are mentally in a way clear. And then there could be in relation to some related party disclosures, if there are related party transactions with post-employment benefit plans, post-employment benefit for key managerial personnel. There could be related disclosures from contingent liabilities, from post-employment benefit obligations. So, all of that, whole host of disclosures is what we need to look at. So quickly to catch up, differences between Ind AS and IGAP. So in the Indian GAAP, we have AS15. AS15 has been suitably modified and has been largely aligned to Ind AS 19, but still there are in a way few differences which is out there. One is on the actuarial valuation. So Ind AS 19, there's a detailed actuarial valuation to determine the present value of the net defined benefit liability. There has to be regularity in a way which is required. So IS 19 does not, Ind AS 19 does not specify the sufficient regularity, whereas in India AS 15, the 3 year, is in a way is been used as a bright line, right? Which is not there under Ind AS 19. Recognition of actuarial gains and losses under Ind AS 19, actuarial gains and losses goes and sit into other comprehensive income. Under AS 15, the actuarial gains and losses are recorded in the profit and loss account. So that's a significant difference between Ind AS 19 and Indian GAAP. And then the discounting of post-employment benefit obligations. So in a way, AS15 talks about discounting with government bond yield rate. Here, here it is government bond. Here we have high quality market yield, reporting high quality corporate bond, right? But if you don't have a corporate bond market, then you go to the government bond in a way from that perspective, right? So I think that's the distinction which is being made out between Ind AS 19 and IGAP AS 15, right? Is a discounting. What's for the maturity profile of your benefit obligations? What is the discount rate I need to use? And it says that AS 15 says government bond rates is what you take, whereas Ind AS 19 says you should take corporate bond rate. But if you don't have the corporate bond market so deep for you to have a reliable rate, then you take the government bond rate, right? From that perspective. So a few more, Ind AS 19, similar to IS 37, Ind AS 37 also talks about the constructive obligations, and you need to provide for them as well. AS 15 does not deal with the constructive obligation. I mean, that's the concept not there under Indian GAAP. And then, Ind AS 19, the employee definition includes directors, and here only whole-time directors are included. So that's a subtle technical nuance between Ind AS 19 and AS 15. So I hope a lot of this in a way makes sense to you, and you're clear as to what's the nuance for accounting for employee benefit. As I said, think of you as an employee or think of you as an employer. And then, what are the benefits you're offering to your employee, or, what are you receiving as an employee, and start visualizing all of that. And then what we talked about in 4 different categories, which is your short-term employment benefit, post-employment benefit, other long-term employment benefit, and then your termination, settlement, or curtailment. I mean, these are 4 different types of broad categories, and you can possibly fit everything into this. Post-employment is your retirals, your short-term is your salary, wages, and other stuff, and your other long-term is like retention stuff, and so on and so forth. And of course, your termination, curtailment, settlement, is what is self-explanatory. Of course, you also have to deal with something called past service cost. So, and then all in all, I mean, interesting topic, right? Interesting topic from overall accounting and reporting perspective, right? So there are some extract from the annual report, which is out here. And what I'll do, I'll request my colleague Amit to take you through all of this, as well. Thank you very much. ये एक्सट्रैक्ट तो तुम कर लोगे ना? क्या प्लान है?
मैं करूँगा, that's not problem.
क्या ये मेरे को करना था क्या?
We were not sure. वो एक्सट्रैक्ट तो रखा हुआ था कि you suggested to अंकित जब उसने किया था.
Okay.
कवर कर लेना.
Okay.
I can cover that as well.
कितना है? कितना?
3-4 पेजेस.
ओके ओके, तो कवर करके नक्की करता है ना, खत्म
जैसे
हो,
आपको कंफर्टेबल
बेटर रहेगा नहीं? ओके ओके ओके. So let's just talk about the annual report of Dabur India Limited. This is a public information. So what you see here, they have a defined contribution plan as what we talked about. A contribution plan like PF, so amount of so much crore has been recognized as an expense recognition, and then in the consolidated statement of profit and loss, right? Similarly, on defined benefit plan, they have said they've got gratuity, which is a funded plan, not an unfunded, funded gratuity they have. Then they have post-separation benefit for directors. Then they talked about different assumptions, that right, the exposures, which is your risk factors, salary increases, investment risk, discount, which these are all actuarial risk, right? The financial risk and the demographic risk, all of that is what is being talked about. And then you look at the detailed table, which talks about the different components of the retirement benefit cost, right? Which is your present value of obligation at the beginning of the year, and then there is a transfer from defined benefit to defined contribution plan. That means there is some change in the plan here. Then you have interest costs, you have service costs, you have paid out the benefit, you have actuarial gain or loss, and then your projected benefit obligation at the end of the year. And you have to do it for the comparative period as well. And you've done a separate disclosure for directors, like the key managerial personnel. There are some separate disclosures which is given out here. And then there are other tables which is out here, which is the fair value of the plan assets. So we saw first on the benefit obligation. Now we are seeing on the plan assets, which is again talking about what was my opening balance, and then what is my interest income, and then what are my contributions, what are your withdrawals, what is the actuarial loss. All of that is what is written out here. And then what is the net liability, which is the difference between the obligation minus the asset, right? Obligation at the end of the year, the fair value of the plan asset, and you see this number comes from here, and this number comes from the previous table. And unfunded, that is what is the unfunded liability, which is 16.56 CR in this case, right? And then whole host of other stuff, right? So the component of P&L, right? The service cost, the net interest cost, the total expense. So service cost and the net interest cost, they don't have any past service cost or the termination, settlement or curtailment cost. And then what goes into your actuarial gain or loss, right? Which is this much on the year, and then on asset at the end of the year. All of that is what is also in a way been disclosed. Then maturity profile, right? Which is how much I need to pay, what's the time, right? Within 12 months, this much I need to pay, 2 to 5 years, and more than 5 years, this is what I need to pay. Impact of change, the sensitivity analysis, right? If I have to change my discount rate by 0.5%, my liability will in a way go up or go down, right? Depending upon the direction in which, if I'm decreasing, right? So higher discounting, the liability will come down. But if there's a decrease in the depressed interest rate environment, my liability in a way going to go up from that perspective. So sensitivity due to mortality and withdrawals are not material. So if they are not material, you've said that there are assumptions, but they are sensitivity risks are not material, and hence we have not done so. But on the salary and the interest, it is material. The change could be material, and hence they have disclosed that. And similarly, you look at the disclosure of all the actuarial assumptions. They have to disclose the discount rate 7.8, future salary increase, the retirement age, the mortality rates, up to 30 years is this, and all of that, and the best estimate of expense for next annual reporting year, that also in a way is being provided here. So it's a very, very comprehensive, right? The disclosure is what is required. And you see, started from the contribution plan, then the benefit plan, and then all the assumptions, and then all the tables, and then the sensitivity, and so on and so forth. So all of that, and you should in a way look at few more companies for you to in a way develop a deeper understanding of some of these disclosures. And the beauty of this, that once you start developing an understanding, you will see number from one table move to another table, then move to another table, right? All numbers are just so interlinked that once you see few of them, you will start enjoying how this whole thing, like we see that if there's a number on the balance sheet, it goes to the P&L, and then there is a number on the cash flow, and then there's a number on the disclosures or on the stockholders equity. So all numbers, there's the integrity of numbers, right? All of them are interconnected. That's make the whole in a way statements, right? So that's what you will also experience here, is what we see from that perspective. Okay, so now we are at the end of this, and there are a few more questions, which my colleague is going to help you take you through, and then wish you all the best. Thank you very much.